Hi, my name is Sergio, and today I will summarize and analyze a recent financial news that was published by Bloomberg Green on the 6th of May of the present year. The title is Investors Cling to Australian Debt Despite the Pressure to Go Green. To get a bit of a background, we all know that Australia is a resource-based economy and is currently underperforming when it comes to take actions against the climate change if we compare it to other nations. Australia is the world's third biggest carbon dioxide emitter per capita and has not yet set a net zero emissions target. Also in 2013, Australia scrapped the price on carbon, and the reduction target of greenhouse gases by 2030 is pretty low. It ranges from 26 to 28% if we compare it to the US, which is 50%, or Canada, that ranges from 40 to 45, given that it's also a resource-based economy. So the main discussion in this news is about the investment decisions of holding Australian debt, besides the preference of shifting the money away from countries and assets that do not align with the ESG targets. This is of course a challenge for global asset managers, as clients are demanding to invest in greener portfolios, and Australian debt underscores these portfolios. However, these managers justify these investments on their duty to make profit. It's also important to highlight that more than 50% of Australian debt is held by international investors by the end of 2020. I would like to point out some of the portfolio managers' opinion. Uh, Banu Singh, head of Asia Pacific Portfolio Management at Austin, Texas, justified holding Australian debt in its sustainable fixed income fund on the goal of meeting both the ESG and the investment objectives. On the other side, Rickard Skolton, senior portfolio manager at Robeco, explained that they have avoided Australian debt on their ESG integrated portfolio because it doesn't align with the carbon dioxide profile requirements. However, the firm still holds the bonds in other funds. Other portfolio managers such Harvey Bradley at Inside Investment International, a London-based firm, highlights the effort that Australia is making within the wider spectrum of ESG, including the production of cheap energy from renewable sources and the way that Australia has put on the social and governance factors. This article also explains the reasons why to invest in Australian bonds despite the pressure to go green. And I would like to show this image because the article was updated a few hours after it was first published. And the new title is Why This Climate Laggard Nation Still Attracts Investments. And the reason is because the Australian dollar is one of the strongest currencies, and also because Australia is one of the few countries that hold a AAA credit rating from Standard and Poor's. So this means that it's more likely to pay back its debt. However, this article also states that the climate change might impact this rating. Also, the fact that Australian debt is owned in its biggest percentage by foreign investors, as we already mentioned, it makes the country's debt among the top performers in Asia. So what are the concerns? As I mentioned already, international funds are still purchasing Australian debt. And I would like to bring the first phrase that opens the news, and it says, Australian isn't paying the price of being a climate laggard, at least not yet. According to a Deloitte article, Australia's economy could be contracted by 6% over the next 5 decades if it doesn't make sufficient progress to decrease its greenhouse emissions. I'm not going to go into much detail into this article, but it states that if key trading nations source cleaner materials elsewhere, about one third of the economy and almost a quarter of the workforce are exposed to disruption. And here I would like to highlight two examples of funds that have already been excluding Australian debt in their portfolios and have been considering governments that are taking more actions in their decarbonizing targets. And this is because they are more attractive to their ESG profile. I would like to start the analysis of this news by understanding the effects of the declining appetite for Australian bonds on the currency exchange rate. As we all know, the Australian dollar, as other major currencies such as the US dollar and the Japanese yen, adopt a floating exchange rate regime. This exchange regime allows the exchange rate of a currency to move accordingly to the supply and the demand. What it means is that if the demand of the Australian dollar decreases because international funds are more likely to invest in bonds with higher ESG profile, the currency will depreciate relatively to the other currencies. As the foreign currency increases, the prices of foreign goods, services, and financial assets will increase in parallel as well. So this means that the cost of the debt for Australian government, large corporations, and financial institutions that raise funds in the international capital market will increase as well. Likewise, for international investors' perspective, inflows obtained from coupon payments and the repayment of the face value of bonds will decrease as well, as these payments are made in the Australian currency. On the other side, the lower the exchange rate is, the most competitive the country's exports are, as price of goods and services decreases for foreign countries. Now, I would like to touch bases on the second main reason given to invest in Australian bonds, and this is that the country holds a AAA credit rating. As we all know, credit rating agencies analyze the ability of a debt issuer to make interest and principal repayments as they fell due. S&P issues an opinion about the creditworthiness of Australia to meet its financial obligations. So far, Australia has got the highest rating, but this article also states that climate change will impact this rating. And this is because rating agencies agree that environmental, social, and policy consequences of climate change will directly affect government and corporation creditworthiness. And the possible transmission pathways are the physical damages from extreme weather events, consumer movements, transition risks, and litigation risks. So what happens if Australia reduces its creditworthiness? What happens if its rating downgrades? So the cost of public and private debt will increase as investors will require a higher yield. Investors will demand to be rewarded by the extra risks that they are taking. So here we can see that the formula of the price, the present value of a bond, is the sum of the present value of the coupon payments plus the sum of the present value of the face value of the bond. So as the year increases, the prices of the bond will decrease because they will be discounted with a higher yield. As I mentioned before, one of the consequences is also the increase of the cost of the public borrowings. As we all know, the government bonds are long-term instruments generally used to finance capital infrastructure expenditure, such as hospitals, roads, and schools. Since the GFC, Australian government's expenditures exceeds its revenues. This arises the Australian borrowing requirements. If the current market yields on bonds rise, this affects the government in the way that it will collect less money to fund its long-term investments. I would like to finish this analysis by formulating a question, which is it worth it to underweight Australian debt, favoring state governments that are more attuned to decarbonizing in order to consolidate greener portfolios? So this news really got my attention in a way that the strong impact that can have the information on an efficient market. So when I was reading this article, I could infer that investors might start neglecting Australian debt, pursuing a transition towards a greener portfolio. So this article titled Australia as a climate laggard nation because it's only reducing its emissions by 26% by 2030. So I wanted to have a further information about like the amount of carbon dioxide that Australia emits. And if we see in this pie, Australia only contributes to 1% of the total carbon dioxide emissions in the world. So the question can be translated to, is it really greener? My portfolio, let's say, if I invest in US debt as they are committed to reduce 50% of its emission, but still that percentage will be way larger than the Australian contribution. So to finish, I would like to bring a section of a paper mentioned in this news, published by the University of Cambridge and the Bennett Institute, that says, whilst enthusiasm for greening the financial system is welcome, a fundamental challenge remains. Investors and business lack of necessary information. This is all for today. Thank you for listening.